Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 62, we're going to talk about interrelated and circular calculations that can come up in tax and how these can cause issues that could spiral out of control to create a very large and unanticipated tax liability. Now, this isn't a perfect presentation. I just illustrate these principles and the easy fixes, but in no way do we calculate the limits of this problem or how far the circular calculations could potentially extend. Now, as always, this presentation is not intended to substitute for legal or tax advice. So I have to apologize. I blanked on the name of this case and I couldn't find it in a quick search. I remember this case specifically from an income tax course I took in law school, but I'm going to highlight my recollection of the facts to show an income tax circular calculation issue where maybe there's an employment contract where the employer agrees to pay compensation but also agrees to pay all income tax liability generated by that compensation as, additional compensation essentially to the employee. But the catch-22 here is that the income tax liability paid generates additional compensation, which then generates additional tax, which then continues to increase the compensation, then increase the tax, then increase the compensation, and increase the tax, and it continues on and on and on, and there's no limit because the employer has agreed to pay all of the income tax liability. So the easiest fix to this is to not agree to pay all income tax. And no employer has agreed to that since this issue really came up, and I forget the resolution, but it's generally a good idea, especially in the compensatory realm, to avoid having to have a liability to pay part or all of an employee's income tax liability, because if you agree to pay somebody's income tax, that act in and of itself creates additional income and consequentially additional income tax for that person. Now, it's more rare, but this could potentially come up to create a gift tax issue as well. This would happen in a situation where income tax is paid not as part of a compensatory arrangement, but maybe in an inter-family or intra-family relationship where maybe a parent gifts an asset to a child and agrees to pay the income tax on the income generated by that gifted asset, which creates an additional cash gift. And then if that additional gift is invested to generate more income, the tax paid on that income would become an additional gift, so on and so forth. Now there's a lot of permutations to this. This by no means is a perfect example, and a lot of times you'd have these gifts covered by annual exclusion and lifetime exemptions and so on and so forth. So usually there'd be no gift tax issue, but the easiest fix and the most compelling way to avoid this issue is to gift assets in a grantor trust, because the IRS has ruled that the income tax paid by the grantor on behalf of the trust beneficiaries would not be treated as an additional gift to those trust beneficiaries, and that's especially important in the context of an irrevocable trust, because you can't use your gift tax annual exclusion for gifts of a present interest in trust unless you also grant crummy powers or structure the trust in a certain way, and you're not going to want to give crummy powers to those income tax payments because that would cause its own issue. But I do want to caution everybody on the use of grantor trusts, where if you try to send this back the other way and create an obligation for the trust to make tax distributions back to the grantor or pay the grantor's income tax in turn, on the back end, what that means is that those trust assets could be included in the grantor's gross estate for estate tax purposes, which nullifies the entire reason for making gifts to an irrevocable trust. Then finally, we're going to look at an estate tax issue, and this is best illustrated by looking at the case of the charitable and marital estate tax deductions. Now, this isn't an issue if marital or charitable deductions are used to zero out the estate tax liability. This only becomes an issue when there is an actual estate tax that is paid. Now, most estate tax documents, and if they're silent on this, most state laws also have language that deals with what's known as tax apportionment. In other words, since the estate tax is tax inclusive, then the assets that generate that estate tax liability are reduced by their share of the tax before ultimate distribution to or for the benefit of the beneficiaries of the estate or trust. Now, a bad situation here would be when estate tax is paid out of property that does not generate estate tax because that property might be eligible for the charitable deduction or the marital deduction. The consequence is that paying the estate tax out of that property would reduce the amount of the deduction, which would consequentially increase the taxable estate, which would increase the estate tax due, which then further reduces the deduction, and repeat that ad nauseum, and you can see how that quickly spirals out of control. So the easy fix is just, especially when you're looking at estate planning documents like a will or a revocable trust, to make sure that the tax apportionment language prohibits the payment of estate taxes from property that qualifies for a marital deduction or a charitable deduction. That's something that's usually included in documents, but it's something where if you ever review them, it's a good thing to check off your list as you go through just to make sure that language is indeed included in the document, and if not, to make sure that that might be part of the state tax apportionment statutes that might apply in default of specific will or trust language to that effect. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.